Welcome to the Deep Dive, the show where we cut through the noise of earnings calls to bring you the sharpest insights.
That's right.
Today, we're doing a deep dive into Invesco Mortgage Capital, that's ticker IVR, and their second quarter 2025 performance.
And it was quite a quarter.
It really was. Not just another earnings report, definitely defined by some, well, surprising market shifts and a pretty decisive strategic pivot from management.
Yeah, you could really see them reacting to the environment.
So our mission for you, our listener, is to understand not just what happened, but, why it matters and what IVR's strategy, it seems more defensive now, carry focused, what that signals about their confidence going forward.
Especially with the Fed maybe looking rate cuts down the line.
Exactly. So let's get right into the headline numbers for Q2. And like you said, it was a bit of a mixed bag, to put it mildly.
Yeah.
GAAP EPS came in negative $0.40. That's a pretty notable downturn from positive $0.26 last quarter.
Big swing there, but then you have the non-GAAP number.
Right. Non-GAAP earnings available for distribution, EAD per share, that actually came in pretty solid at $0.58, impressively beat the consensus too.
Which is key for covering that dividend.
Definitely. Revenue, though, was $17.73 million, which missed the consensus. And book value per share, BVPS, that saw a decline, down 76 cents quarter over quarter, ended at $8.05.
Ouch. And the economic return reflects that hit to book value.
Yep, negative 4.8% for the quarter. That combines the income and the change in portfolio value.
But crucially, that common dividend held steady.
Didn't change.
Yeah.
And also, importantly, they proactively reduced their debt-to-equity leverage, took it down from 7.1 times to 6.5 times.
Which is a significant de-risking move. That negative 4.8% economic return and the dip in book value, those are certainly headlines.
For sure.
But that steady $1.58 EAD per share, comfortably covering the dividend, that sends a powerful signal too.
Yeah, it tells you the core income engine is still working despite the turbulence.
Exactly. And the market reaction kind of reflected this nuance, didn't it?
Yeah.
Shares had a modest positive bump on the day of the call.
Right. Suggests investors are weighing both sides, the headwinds, but also management strategy and that commitment to the dividend.
They're looking at the adjustments being made.
Okay, let's unpack those headwinds then, because Q2 really was a roller coaster. Market volatility-wise, what was really driving that unpredictability? And maybe more importantly, how did IVR react?
Well, early in Q2, the market got genuinely rattled. April 2nd, you had those tariff announcements.
Right.
And that immediately sent interest rate volatility just soaring and triggered a broad repricing of risk assets. Agency mortgages, a core holding for IVR, they significantly underperformed treasuries right out of the gate.
It was a sharp shock.
Very sharp, very sudden.
But what's truly striking is how fast things turned around. Just a week later, April 9th, a 90-day pause on those tariffs gets announced.
Yeah, complete reversal.
And that led to a totally different path, right? Interest rate volatility started declining steadily through May and June.
And that shift allowed agency mortgages, CMBS, broader risk assets, really, to recover quite meaningfully by the end of the quarter.
So this kind of whipsaw volatility spike then retract. How did that specifically hit IVR's hedging? Because it wasn't all smooth sailing even with the recovery.
No, it wasn't. And this is kind of technical, but really important. While the broader market recovered, something specific happened. Swap spreads tightened significantly.
Okay, remind us what that means exactly.
So think of a swap spread as the difference, basically, between the fixed rate on an interest rate swap and the yield on a comparable to Treasury bond. When the spreads tighten, the premium shrinks.
Got it.
And for IVR's interest rate swap hedges, which are essentially set up to benefit from wider spreads, this tightening is like a direct hit. It reduces the value of those protective positions.
So that's a big part of the negative economic return and the book value drop.
Absolutely. It directly contributed to that negative 4.8% number and the decline in book value. It really highlights how these hedges work. They protect against one thing, maybe rising rates overall, but expose you to these other, sometimes counterintuitive market dynamics like spread tightening.
It's a tricky balancing act.
Very much so.
So understanding that sort of intricate dance with the swaps and the hit to book value, it makes sense that management then leaned more defensive with the core portfolio itself.
It does. It certainly seemed amplified by Q2's events, but it also reinforced a direction they were likely already considering.
Right.
Management explicitly mentioned elevated near-term uncertainty as the reason they trimmed leverage from 7.1x down to 6.5x. That's a clear de-risking move.
And the portfolio size?
Stands at $5.2 billion, mostly agency RMBS, that's $4.3 billion, and then $0.9 billion in agency CMBS.
Okay.
And crucially, they kept a big chunk of cash and unencumbered investments, about $362 million. That's a solid liquidity buffer, another sign of that caution.
And within that defensive shift, were there specific changes in what they're holding? Asset allocation tweaks.
Oh yeah, definitely. They notably exited their to-be-announced, or TBA, securities by the end of the quarter.
Which are more market sensitive generally.
Exactly. Instead, they're favoring specified pools in agency RMBS, particularly ones with higher coupons and lower loan balances.
Why those specifically?
The thinking is they offer more predictable prepayment behavior and more stable funding costs. That's key in a volatile market. They specifically cut back on their 30-year 6.5% exposure, felt that was more vulnerable.
Makes sense. Protect the downside. And speaking of protection, their hedge book heavily weighted to interest rate swaps, right? Even though those caused some pain in Q2.
Right, about 80% of their rate hedges are swaps on a notional basis.
What's the conviction there? Why stick with them?
Management sees them providing attractive returns on equity over long haul. Despite the Q2 headwind from the tightening spreads, they believe, fundamentally, that swap spreads will eventually widen again.
So it's a longer-term bet?
It's a strategic position. They're willing to take some short-term valuation hits because they think the underlying dynamics will ultimately favor those positions. It calculated risk management, costly this quarter, but it aligns with their future outlook.
Okay. Let's shift to agency CMBS for a second. They didn't buy any new ones, but the allocation actually went up.
Yeah, a little counterintuitive. No new purchases because they felt the relative value compared to agency RMBS wasn't great in Q2.
Oh.
But the allocation still ticked up from 15% to just over 17% of the portfolio. That happened mainly because their agency RMBS holdings decreased.
Ah, denominator effect.
Exactly. But management still sounds quite positive on agency CMBS overall. They cited the strong fundamentals, prepayment protection, fixed maturities, limited new issuance.
Solid characteristic.
Very solid. And they expect CMBS spreads will tighten when the Fed eventually cuts rates, but with a lower beta, less sensitivity compared to lower coupon agency RMBS.
So it adds a bit of stability, maybe?
That seems to be the idea. It's defensive, yield accretive, and less jumpy in response to rate swings than some RMBS. Way to keep income coming in while shielding book value.
Okay, let's look ahead then. Management gave an outlook, cautious near term, you said, but constructive longer term for agency RMBS and CMBS. What's driving that optimism?
It really boils down to the Fed, Federal Reserve policy. Fed funds futures are now pricing in about 2 rate cuts by the end of 2025.
Okay.
And maybe another 2 to 3 cuts in 2026. That's actually a slight increase in expected cuts compared to earlier estimates. Creates a more favorable backdrop.
And what do they think those cuts will actually do for the mortgage market?
They believe the cuts will lead to a notably steeper yield curve.
Okay, long rates falling less than short rates.
Right. And also a further decline in interest rate volatility. Those conditions, plus they expect increased demand from banks, overseas investors, money managers who've been kind of on the sidelines.
Waiting for stability.
Pretty much.
Yeah.
All that should provide a very supportive backdrop for agency mortgages.
Sounds plausible. But what about quantitative tightening? QT. Isn't the Fed still shrinking its balance sheet?
Good point. The Fed did slow its pace of Treasury runoff back in April, down from $25 billion to $5 billion a month. Agency RMBS runoff stayed at $35 billion.
Okay.
But overall, QT is now expected to wrap up in 2026. That's a year later than previously thought.
So it sticks around longer.
Yeah, and that extended timeline could influence supply dynamics, maybe offset some of the positive demand trends if the Fed holds on to assets longer than hoped. It's definitely a variable to watch.
Okay, so beyond those big market forces like the Fed and QT, IVR also pulled some levers themselves this quarter, capital actions you mentioned.
Yes, they used their at-the-market program, the ATM, sold about 283,000 common shares during Q2.
Okay, raised a bit of capital.
And then post-call, they filed to potentially sell up to another 25 million shares from time to time.
Wow, that's a lot more potential supply.
It is. It gives them capital flexibility, obviously, for opportunistic investments if they see them. But yeah, it introduces potential supply overhang for the stock price.
How did they frame that? Are they planning aggressive growth?
Not really, no. Management was pretty clear.
Yeah?
They're comfortable with their current leverage. They see it as enough to cover the dividend.
Right.
And they're not going to just lever up simply to hit some return target, especially when they see the current levered ROIs as already attractive.
So when would they increase leverage?
Only if rate volatility really comes down and mortgage spreads tighten meaningfully. Basically, when the environment looks fundamentally more favorable and less uncertain.
Got it. It seems like this feeds into that idea of shifting towards a carry trade focus. You mentioned ROEs being attractive. What's the difference between carry and total return, and why this shift now?
That's a really crucial distinction they made.
Yeah.
So a total return strategy, that looks at everything. The income and the change in the assets price, the appreciation or depreciation.
Yeah.
A carry trade, though, is much more focused on just generating net interest income. That's the spread between the yield they earn on assets and what it costs them to borrow money to buy those assets.
Just the income stream.
Primarily, yes. Management explicitly said they're leaning more towards carry right now. Why? Because they think significant further tightening of mortgage spreads, the kind that drives big asset price gains, is probably limited unless or until banks jump back into the market more aggressively as buyers.
Which might not happen soon.
Might not. So by focusing on carry, they're prioritizing stable, recurring income and making sure that dividend is covered. They pointed to their current levered gross ROEs in the low 20s for higher coupons.
Pretty decent.
Very attractive, they said, especially for investors with longer horizons. It suggests they see the current market as one where grinding out consistent income is key, and they're comfortable with a lower appetite for big price gains in the near term.
All right, makes sense given the uncertainty. Which brings us nicely to our This Is Not Financial Advice segment. Time to pitch an outrageous but plausible trade based on this IVR deep dive.
Okay, let's try one. Given IVR's clear strategy favoring those higher coupon specified agency RMBS and their conviction that swap spreads will eventually widen. How about this?
Lay it on us.
We'll call it the levered steepener trade.
Yeah.
So, first part. You go long IVR common stock. Your betting management navigates this period well, benefits from eventual rate cuts, and that steeper yield curve they expect.
Okay, direct bet on the company executing.
Exactly. But then, simultaneously, you pair that with a long position in medium to long duration interest rate swap spreads, like maybe the 5-year versus 30-year swap spread.
Betting specifically on those spreads widening, just like IVR's CIO expects.
Precisely. The outrageous part is you're doubling down on their specific thesis, mirroring both their asset preference and their macro call on swaps. Could amplify returns if they're right on both counts.
And the plausible part.
Well, the plausible part relies on the market eventually agreeing with management's longer-term view on agency mortgages, and the fact that historically, swap spreads do tend to widen in certain environments, maybe fiscal uncertainty or shifts in supply and demand for duration.
Interesting. A direct play on their articulated strategy.
Levered steepener. Remember, folks, absolutely not financial advice.
Definitely not. Okay, that wraps up our deep dive into Invesco Mortgage Capital's Q2 2025 earnings call. We saw a quarter that started volatile,
Very volatile.
a clear defensive shift in strategy, reducing leverage, favoring specific assets,
Yep, and focusing on carry.
and a clear, though cautious, outlook for the future, really hinged on what the Fed does and market stabilizing.
I think the core takeaway is that focus on protecting book value and maintaining the dividend. They're using that carry focus strategy today while waiting, maybe positioning for a more favorable environment later on.
Prudence now, potential opportunity later.
Seems like it.
So, for you, our listener, here's a final thought to chew on. If IVR's carry first, more defensive approach is the right call for this environment, what does that imply for other mortgage REITs? How might they need to adjust their own strategies if they face similar conditions?
Yeah, good question. Does everyone need to hunker down a bit? As always, remember this discussion is purely for informational purposes. It does not constitute financial advice.
Absolutely. Investment decisions really need careful thought about your own situation and probably professional guidance.
Couldn't agree more.
Thank you for joining us on the deep dive. We appreciate you listening and encourage you to explore these topics further.
Until next time.
Stay well informed.